For the first time in history, we've got an asset class where we've got 100% transparency. We can look at transactions. The blockchain and Bitcoin helps us to figure out what's going on behind the scenes. When we buy a stock, right, with a traditional broker, we buy Tesla stock. We don't really know who's currently buying, who's selling, who's dumping on us. We don't know if it's the big whales that are artificially depressing the price. We don't know if there's some kind of pump and dump going on in the smaller caps. But with Bitcoin, with crypto, we can have a look at the individual transactions. But interestingly enough, most people don't take advantage of that data. Many people say that it's impossible to predict where prices will go. And to a degree, this is true. If there's one big player that decides to dump everything, of course, prices go down. However, we can make a good estimation whether or not something is currently cheap or expensive. There are always some kind of anchor points. For stocks, for example, we've got price to earnings ratios. For property, we've got return on investment. What's our gross rental yield? For crypto, we've got interesting metrics most people aren't looking at. Average cost basis, realized profit, coin days destroyed. And it's very interesting how those metrics tend to be aligning with the crypto cycles. Let me show you what I mean. Have a look at this chart here. This is the net realized profit and loss in US dollars for Bitcoin over time. This chart starts in 1917. So Bitcoin went up to 20K to then come back down to 3.5K to then recover above 60K to then come back down to 16K. And now we are in the 100K range. Isn't it interesting how during a bull market, some people take profit, so they're realizing their profit, but during a bear market, there is some loss realization, but it's nowhere near to what we saw in profit realization during the bull market. So it seems like there is less liquidity and less trading happening when the market is cooling off, when prices tend to go down. There's always this massive run up and the subsequent cool off period, another massive run up with a cool off period, this time with a bit more selling. And recently, again, we had our run ups. When the long-term holders are locking in profit, the short-term holders now have a higher reference price. And when then the price goes down, those people might just continue holding. They might not realize losses that quickly. It seems to be a bad idea to buy when the long-term holders are realizing their profit. Here's the same data, but this time not measured in US dollars, but measured in Bitcoin. And isn't that fascinating? It seems like the number of Bitcoin that get moved during a bull market and a bear market aren't actually that different. Those wicks tend to be somewhat similar in magnitude. The reason why it looks smaller on the US dollar chart is simply because the price of Bitcoin is lower. We want to buy when people lose hope. We want to buy when there is maximum pain, when people realize their losses. In other words, when people don't believe in Bitcoin anymore, when they're not even waiting out the bear market anymore, when they have to sell even though prices are down. In the property sector, that could be comparable to buying houses that get foreclosed. In the stock market, it could be buying stocks that currently trade for very low PE ratios, but where we do believe that long-term the stock might still survive. In the crypto markets, we can simply use an aggregate metric, the net realized loss. So people are not just in loss on paper, they actually have sold at those lower prices. It appears as if recently the market is cooling down again, right? There isn't that much net realized profit anymore. It seems like all of those metrics are going down. Even the net realized profit ratio is close to zero. And isn't that fascinating, given that we've seen already Bitcoin coming down by 22% from the all-time high? The market appears to be in balance, yet the price continues to go down. Probably this here is one of the reasons. This shows how much capital flow is required per unit of valuation change. If the market is rallying, a lot of dormant Bitcoin suddenly gets moved and gets sold off. Thus, the liquid supply is going up. Thus, it takes more capital to move the price even higher. However, when the opposite is happening, when the long-term holders just continue to dollar cost average and they are not releasing their Bitcoin, the liquid supply is low, and so it doesn't take that much more capital to move the price. Whenever it takes more and more capital to move the price, we require a lot of demand for further price appreciation, and that tends to be the time when the rally stops. Let's remove the ratio here, just look at the extreme cases. We want to rather be out of the market or at least de-risk whenever there's too many liquid Bitcoin floating around. That's probably what's going on here. The price is going down because it takes billions and billions of dollars for it to stabilize. The long-term holders are still selling. Have a look at the 90-day average of the Bitcoin days destroyed. The short-term holders tend to not change that much in the days destroyed. The long-term holders, they are very much cyclical and tend to just take profit whenever Bitcoin goes up. So it's the long-term holders that stop a rally. If you have a lot of Bitcoin on the sidelines and you wait just for the price to appreciate and you start out with a portfolio allocation of say 10% and then Bitcoin goes up by 3 or 4x, suddenly you've got 30% of your portfolio in Bitcoin, you might consider taking some of that profit, right? And maybe take those 20% and put this into another asset class. Say you buy a house with it, or say you just consume it away. But if you feel comfortable with a 10% allocation when Bitcoin is cheap, you probably don't want to have a 30% allocation when Bitcoin is expensive. And that's probably what's going on with this high volatility in the coin days destroyed of the long-term holders. Now, in case you don't know what coin days destroyed means, if you hold one Bitcoin and you don't move this for an entire year, and after 1 year you suddenly move it, you're probably likely also going to sell it. That means you're destroying 365 value days or coin days. When you hold 2 Bitcoin and you don't move it for half a year, and after half a year you decide to move it, you're also destroying 365 coin days. So the coin days destroyed is a metric of how much dormant Bitcoin get reactivated. And the long-term holders, when they move their Bitcoin suddenly out of nothing, that's the time to potentially sell, right? Because the diamond hands, the people that tend to normally hold, they suddenly decide to not be that much more diamond. And that's then of course the time to rather be on the selling side as well. And that's also how I personally have timed my exits. I've sold a lot of Bitcoin at 72K. I've also sold quite a bit of Bitcoin close to 100K. We can use all kinds of metrics for this. We can use the 90-day sum. We can also use the 30-day sum. That's a bit more volatile. But again, it makes sense to rather exit when this is peaking during a bull run. Interestingly enough, we have also seen one time a spike at the end of a bear market. This was the absolute maximum capitulation. Most people did not believe that Bitcoin has any future after the drop from more than 6K down to below 3K, because the 6 to 7K mark was a pretty nice floor up until that crash. This was the miner capitulation. So a lot of Bitcoin mining companies that tried to make money, they went out of business and they had to sell their stock, creating this additional drop. Outside of this absolute maximum capitulation, we've never seen something similar. Usually now we see the coin days destroyed being elevated whenever Bitcoin hits new high prices. Here's another way to look at this. This is the Bitcoin value days destroyed multiple. Again, it gave a very nice signal at 72K. Let's go back to the miners. The Bitcoin mining industry also goes through cycles. So sometimes Bitcoin miners make a lot of profit, sometimes they don't. And that of course also has impact on the price. So when the Bitcoin miners tend to make money, so this is just an estimated cost based on the hash rate, and that's then compared with the current price. When the miners tend to make money, it might make sense to start offloading some Bitcoin. When they are making losses, we tend to be in a bear market and it might make sense to accumulate more. Currently, the miners are still profitable. So we are coming down in the Bitcoin price, but we are nowhere near yet in a confirmed bear market. I believe that we are likely going to go further down from here, but the miners don't yet feel that pain. They're just seeing declining profits. They're not yet seeing losses. Now, instead of looking at realized losses and realized gains, we can also just check the net position change of the long-term holders. And isn't it interesting how the long-term holders tend to just dollar cost average most of the time? Most of the time we just see more and more accumulation, but then occasionally we see profit taking, right? This is when this is turning red. It does make sense to imitate those movements to a degree, right? We want to take profit when the holders take profit as well, and we want to dollar cost average in when they average in as well. Currently, they aren't buying yet. Currently, they're still selling off. Now, this all doesn't give us a crystal ball, right? It's simply just additional data points. I think this data helps compared to just looking at price data, right? When we know what the long-term holders are doing, when we know what the people are doing that tended to make a lot of profit in the past, this might give us a higher likelihood to also make some profit in the future. I'm currently making a lot of money by betting on falling prices. So is the premium community. So in case you want to check that out, feel free to check out the link down below. It's thebitcoinstrade.com. Looking forward to seeing you there. If you got some value out of this video, feel free to subscribe. I publish videos regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time. Cheers.